Hey, well, welcome back. It's Mark Fielding Pritchard here from Emmy Fieldings, in the middle of a flu season, as you can probably tell. We did a presentation a couple of weeks ago now, I think it was, on interest rate swaps. And we looked at interest rate swaps because we had some clients who were interested in these things. A kind of natural progression from that, therefore, is futures and options and those other kind of fancy derivative instruments. So what we're going to be looking at today is we're going to be looking at foreign currency futures, and we'll also cover foreign currency forward contracts. For people who are going to be doing this in real life, I really strongly recommend that you watch this, get a basic understanding of the terminology, how these things work, and then before you enter into any contracts, go find some people who are experts and take some proper professional advice, or you can come to us, of course. If you are a student for ACCA, ICAEW, any of the accounting studies, then there's probably enough in here for your exams, because complete detailed information on exactly how the pricing structure works and how you pay for them and so on isn't really in your syllabus. So there you go, Mark Fielding Pritchard. Thank you for watching. Please remember to like us on Facebook and subscribe to the channels and send us some messages and stuff. We do get a fair number of messages. We get I think like we're getting 100 students or so a day now coming through the website. If you're watching this and you're thinking, oh my god, I've put this on, it's a complete accident. Well, if you have anyone else who might want to see it, give them a call. Send them our address. We'll be happy to have them on our site. Okay, let's get stuck into foreign currency futures. Okay, so your deal therefore is that your company either has a foreign currency receivable at some date in the future. These things are all used for short-term hedging, not for long-term hedging. So you have a receivable at some point in the future, and that receivable is in a foreign currency, or you have a liability. And again, the liability is in some foreign currency. So your real risk here, therefore, is that you're going to have this movement in currency exchange rates, and that gives you an element of risk. We're only really looking at it from this perspective of hedging risk. The futures market in particular is used mainly for gambling on what's going to happen with foreign currency exchange rates. Foreign currency gambling, I mean, you can learn how these things work here. Go gamble yourself if you want. For those of you who are students, ACCA and so on, you should never be doing that. Certainly not in the exams anyway. So we've got this foreign currency liability, this foreign currency asset, some future date, and we want to look at hedging it. There's two different ways of doing it. The first is by using a thing called a forward. A forward is the situation, therefore, where you enter into a contract, almost certainly with a bank, and the bank guarantees you, therefore, some exchange rate at that future date. So your foreign currency debtor pays you. He pays you, let's assume you're an American company, he pays you in Russian rubles. You take your rubles along to the bank and you get some guaranteed number of dollars. We said American, so some guaranteed number of dollars. The bank will take exactly the number of rubles that you've got. They will take them on exactly the day that you're due to get the money. Excuse me. So therefore, in that sense, you have this idea of this contract to exchange. And that's why most companies use forwards for their hedging, because you can have it. The only limitation is the bank. So as long as the bank's willing to cover you for small sums of money, for large sums of money, and they'll take any dates. I mean, obviously if it's a holiday and stuff like that, but in principle, it's any kind of date. Very, very simple. What happens is certainly if you're, I mean, I've done these things in Britain. You just phone up the bank. The bank call their foreign currency trading department. And in the good old days when I was working in practice, they used to send you a fax, and the fax would come through. It had a rate on it. You phone up, you accept the rate, and that's it. Very easy to organize, and there's usually no fees for these things as well. The bank will give you a rate, and the rate includes some element of profit for them. So you get this idea that very simple to organize, very simple to administer. You just put it on file. When the money comes through, the money will just appear. In fact, usually what will happen is that when the rubles come through, they will just appear in your account as dollars, whatever we said. And you can go back and check that exchange rate. So, it's very, very simple, very, very straightforward. Right. Futures much more complicated. With a future, you are buying a fixed sum of money. If you are assuming that you're using one of the American exchanges like the Chicago or the New York exchanges, then they will be, if they're UK pounds, they will be £62,500. Most currencies work off 125,000 units of currency. So if you're using euros, it'll be 125,000. Others, obviously, like the Japanese yen, are much larger. I think there are 10 million Japanese yen. So therefore, you get this idea that you have to buy or sell a standard amount of foreign currency. These things have standard expiration dates. So in other words, they actually work on calendar months. So they will have March, June, September, December. So therefore, your future will expire on a date. They depend on most of them. In the good old days, back in the 1960s and so, back in the 1970s and so on, it used to be the end of the month, but they moved it because of Christmas. It was difficult to get people to work on 31st December. So now I think there's something like the third Wednesday in the month. So therefore, what's happening is you are buying this standard traded instrument, which in principle gives you the ability to exchange these Russian rubles into, we said dollars, yes, so exchanging Russian rubles into dollars. It's a standard sum of money, it's on a standard date, and so on and so forth. So you get this idea of standards. The reality in real life is the phrase that came to mind there. The reality of this is that you can't actually take delivery. So with a forward, you actually give the bank a certain number of rubles and you get back a certain number of dollars. With futures, you don't do that. With futures, let's assume that you bought some futures. What will happen is you then go into the market and you sell futures. Now, the way the market works is that you can sell futures in advance and buy them back in the future. All that has to happen is that in some period of time, you have to both buy and sell. And what will happen, therefore, is that you will have a profit, or more likely a loss, based on the margin, based on the difference between the buying and the selling price. And assuming that you have a profit, that profit will offset any losses that you've made in the spot markets, in the currency markets. Okay, so futures, this idea of a standard sum of money, standard dates, you can't take delivery of the money, you will simply have a gain or loss on your future. Right, if futures are starting to sound a little bit confusing and you're going, oh my god, what on earth does any of that mean? What we're going to do now is we're going to work through an example, and I'll show you in the example how the system works and how you can use futures for hedging. And not many people do because of the expense, but should you want to, you can use them for hedging. For those of you who are watching this and are going to go on and do ACCA, ICAW, etc., try and learn the steps, because if you learn the steps and you learn the questions, it's actually really quite easy. Okay, so let's start with a little example of forwards. We have here a UK company, so this is the kind of stuff, particularly for those of you who are students, you're going to get in the exam. It's a UK company, so your examiner is telling you that this company is going to be wanting to working in UK pounds. Today is the 1st of January 2014, so Happy New Year. It's also not a working day. And it tells you that the company is due to receive 93,750 on the 30th of June 2014. So we've given somebody 6 months credit, we've sold them some products, 6 months credit, we're due to receive some sums of money. And the exchange rate as of today, right, notice that it says the spot rate. The spot rate is just the exchange rate today, so you can read that in. And as far as if you're doing this in an exam, you'll be given one number. In real life, they'll vary. You'll get different offers from different banks. But in the exam, you just take that as today. And it tells you that it's £1.50 for 1 UK pound. Right, some nice little general pieces of information. And this is standards. Unless you're told anything else, you should assume this. So it tells you that futures are traded at 62,500. And it's telling us that we're using the Chicago Exchange. So CME is the Chicago Mercantile Exchange. It's the market where these things are traded. So these futures are traded. Personally, for me, I was a teacher back in the 1990s, and it was important because this in those days was probably just about the only place where you could get these things. LIFFE, which is the London International Financial Futures Exchange, at that point didn't trade futures. They actually closed because of low volumes of trading. They've now reopened. So Chicago, therefore, has these futures quoted, which are £62,500. Right, there's actually some very important information in there. Again, if you're doing this, even if you're doing this in real life, but also as a student, Chicago, as the name suggests, and you should all know, is physically situated in the United States of America. So therefore, all of your costs, so anything that you're purchasing, and we'll look at fees later, but all of your commissions, all of your payments and so on, are all going to be in US dollars. Because the pound is the foreign currency. Okay, now particularly important when we're talking of buying and selling, because we talk about buying and selling foreign currency. If we're talking about pounds, we want to buy pounds. If we're buying pounds, we're selling dollars. So is it a buy or a sell? Which one do you use? Will you use the buy, because the pound is the foreign currency? So remember, Chicago is in the United States of America. All of your commissions and therefore all of your profits and losses will be in US dollars as well. And when we're talking about buying or selling, we're talking about buying or selling pounds, because the foreign currency is the pound. Okay. So 1st of January, we're due to receive 93,750 spot rate on the 1st of January, $1.50. It tells us that a forward contract is available from the bank, and they will guarantee us a rate. So this is the rate that they'll guarantee today. So they will guarantee that on the 30th of June, if you give them 93,750, you will get back £60,000 and change. Yep. So the bank is giving you a guaranteed exchange rate now. Right, that is your forward. So that's your forward. If you get that, you accept it, you put it on file, that is what will happen. And you're fixed in. If you calculate it out, when I did this, I think it comes out at something around about $1.55. So in other words, if the exchange rate stays fixed, you're paying a premium of 5 cents for every pound to get this guaranteed rate. If the dollar weakens, so we need more dollars for our pounds, so the dollar weakens, then it's telling you therefore that's probably a good deal for you. Right, the final piece of information, this is obviously something in real life that you're not going to know. This is something that you're not going to know. But in an exam, they may give this to you to make the calculations easier. It tells you to assume that on the 30th of June, the actual spot rate and the futures rate is $1.60. So in fact, therefore, the pound has strengthened, and it's strengthened to the tune of 10 cents for every pound. 10 cents in every pound. Okay, that's your basic information. So that's your basic information. If you go into your forward, therefore, you are entering into a contract that on the 30th of June, you will hand over 93,750 and you will get back 64.80. So it gives you the opportunity to fix now. And now usually, as a general rule, not any other fees. If you're a small company, they might ask you for £10 arrangement fee or something. But usually there are no other fees. Can you see, therefore, the advantage of the forward? Excuse me. Can you see, therefore, the advantage of the forward? You enter into this thing, you fix into it now, and you're fixed for 6 months. The only disadvantage of the forward is that it is a contract. So if your customer doesn't pay you on time, you have to go into the market, you have to purchase dollars, and you have to exchange those dollars back. And there'll be a cost attached to that. In reality, what happens is that if you don't deliver the dollars, the bank will just go into your account and do it for you. Okay, I hope that's quite straightforward. And for those of you doing this in real life and those of you in the exam, you shouldn't have too many questions on that. If you have questions, please send them in through the website. Okay, let's move on. Okay, so this slide, at least the first 2/3 of it, are just a straight repeat of what we've already said. For genuine hedging, as opposed to not genuine hedging. But for hedging, most companies would use forwards. In our example, it says that we lose 5 cents. So if you actually calculate the exchange rate in the last slide, you'll see that the exchange rate the bank is offering you is something of the order of 155. So therefore, it's costing you 5 cents. So it's costing you 5 cents for every pound. And again, there are usually no fees, and it's very easy to organize. Right, what will happen therefore is if the company doesn't pay, so what's happening here at the end therefore, please make sure you understand those first 4 points. In the bottom 3 points of the slide, what we're saying is what happens if the customer doesn't pay us. If the customer does not pay us, we have to go into the market and we have to buy $93,750. So therefore it says, therefore on 30th of January we buy $93,750. I hope you're okay with where the number of pounds come from. Remember that we are a UK company, so we do all of these calculations in pounds. The question has told us that the spot rate on the 30th of June is 160. So therefore the cost of $93,000 will be £58,000 at 160. We now have to go through this kind of shimmy shoo shuffle where now you've bought your dollars, you immediately have to exchange them back because that was what you've entered into the contract to do. So you give the bank $93,000 and then they swap them back into pounds, so you fulfill the contract. So it says here we swap them back under the contract. This is the forward contract we entered into on the 1st of January. And when you do that, you'll see that you receive £60,000. So you bought for 58,000, you sold for 60,000, and you have a gain of 1891. So 1891 means that we receive 60,000, we pay 58.5, and the difference is the 18. I hope that my maths is right, and that you get a small gain. The reality of the situation is that what the bank will do is they will just do that automatically. So you'll go to your account and you'll see that the 1891 has appeared, which is quite nice because you've actually got a little gain there. And the disadvantage, of course, is that your customer hasn't paid you. So let's see what happens when he pays you. And because of the movement in the spot rate, of course, you're going to receive less money. Okay, that's forwards. For those of you who are doing exams, if you're looking at forwards, you need to be able to explain what the advantages of forwards are, and you need to be able to calculate that number of 1891 to show what happens if the thing isn't fulfilled. So what we did with the forward was we looked at the forward and we said, okay, this is how we're going to hedge this contract. So now we're still back with Marco again, remember? So therefore, with Marco, what's going to happen is that the customer's going to pay us in 6 months' time. Now is the 1st of January. The alternative as a hedging instrument to the forward is to use the future. And the future is kind of, certainly in real life, comparatively much more complicated. When you use these futures, the way to approach this is to ask yourself 3 questions. This is assuming that you're using them for hedging. The first question is, do we buy or sell? The second question is, how many futures do we buy or sell? And the third question is, which month? Because assuming that we're looking at pound or euro futures, these things close every 3 months and calendar months. Again, right, I'm telling you this, but it's going to vary. If you call up different exchanges around the world, you'll get different products. So we're just going to work through Chicago at the moment. Right, so do we buy or sell? How many futures? And which month? So do we buy or sell? We'll just have a look at Marco's position. And bearing in mind that Chicago is in the United States of America, so the pound is a foreign currency. Right, what's going to happen is that our UK company Marco is going to receive US dollars. With those dollars, it is going to buy UK pounds. When we are talking, we always talk in terms of the foreign currency, and the currency is the pound. So we want to buy pounds. Therefore, we will buy futures. Okay? So we will buy futures. So if you have a foreign currency debtor, you buy futures. Therefore, if you have a foreign currency liability, you will sell futures because you want to sell pounds to receive dollars to settle that liability. That's the logic of what you're doing. So we want to buy futures. And it says on the slide, therefore, we want to buy foreign currency. So we buy futures. Right, the second question is how many? It tells us that pound futures are denominated in units of 62,500, and on the 1st of January we are due to receive 93,750, and the price of the future. Right, remember here that you're looking at 2 things. You're not looking at the spot rate, you're looking at the future price. And you're looking at the future price on the 1st of January. So the future price on the 1st of January is $1.50. You're doing that because that's the number that you're hedging to. If you get this completely correct, you will actually hedge back to an exchange rate of 150. Right, this gives us exactly one future. Right, this is actually pretty unusual and obviously has been written by me for the purposes of this being like an exam question. You cannot split futures, so therefore if you were due to receive $100,000, you would still want presumably one future, or you could go the other way and get two. But the fact that you're going to get exactly one future is almost impossible in real life. Okay? In the exam, you want one future. So we are going to buy one future. The next question is which month, right? What does that mean? Futures close out every 3 months, as far as you're concerned. Again, it depends what the currency is, depends what the exchange is. But for pound futures based in Chicago, they close every 3 months. So advertised, therefore, usually at any one time, you'll see 5 of these. If you go therefore on the 1st of January 2014, you will see March 2014, June 2014, September 2014, December 2014, and March 2015. And the question is, if you want to buy one, which month do you want to choose? Well, if you choose March, what will happen is that future will close in March. So therefore, you will not be hedged from the end of the future in March up until the point when you receive your money, which is common at the end of June. Okay? Now, the reality of these things is that you can roll them over. So in other words, if you buy March, you can then roll that into June at that date. But as far as you're concerned, particularly for an exam, just take it that you want the future, which is at a later date. Right, the second question is, do you want a June future? Right, well, what happens is, it says on the slide, is that these things close somewhere around the middle of the month. As far as the Chicago exchange is concerned, I think they actually close on something like the third Wednesday of every month. That's going to give you 2 months. That's going to give you 2 weeks unhedged. So therefore, for a perfect answer, particularly if this is an exam, you'd probably recommend taking a September future. There is a golden rule to this. You want the future which closes first after you receive or pay your money. So in this case, if it was an exam question, you'd want a September future. If it was real life, you'd probably take the June and just risk 2 weeks. For the exam, take September. Okay? Some exam questions, certainly I know ACCA like you to do this, tell you this. They tell you that assume that the future closes on the last day of the month. If the future closes on the last day of the month, then you want the June future. Okay, you got 3 questions. Do we buy or sell? If you have a foreign currency debtor, you buy. Foreign currency liability, you sell. How many? You take the foreign currency, you take the debt that you're due to receive, and you divide it by the price of the future on today's date. In our example, the 1st of January. And that will give you the value in pounds at today's date, and that's what you're hedging to. Number 3, which month? You take the first future that closes after your risk ends. In other words, after you've received your dollars, or you've received your money, or you've paid your money. Okay? Right. Learn those 3 steps. If you can learn those 3 steps, if you're doing ACCA, if you're doing ICAW, that'll get you 50% of the marks because you set the hedge up. Okay, let's have a look and see now what happens with the future. When we looked at slide number 5, therefore, you're looking at 2 particular points in time. The first is the 1st of January, and the second is the 30th of June. So on the 1st of January, we said we were going to buy 1 September contract. So we're purchasing 1 September contract. Again, I'm guessing many of you may be saying, well, in fact, you'd be better with June. So I'll go with June if that makes more sense. But for me, I would say we purchase 1 September contract. What we then have to do is sit and wait until the 30th of June. So on the 30th of June, we hope that our customer sends us our money. And when our customer sends us our money, we have to do 2 things. Right, please notice that these are completely independent actions. The 2 things that we have to do is that we have to, 1, exchange our dollars for pounds at the spot, so in the spot market. Right, please understand that therefore, so your customer pays you, he pays you your $93,000, whatever the sum of money was. You take your 93,000 bucks and you exchange those into pounds. And you do those at the spot rate on the 30th of June. The second thing that you do is you close out, or you what's called squaring off, you square off your future. We purchased one future, so what we will now do, in fact I think we said they were September, so we purchased one September future. What we will then do, or therefore do, is we will go into the market and we will do the opposite. So we will sell one September future. And as far as your position is concerned, you therefore have a liability to purchase and a liability to sell $62,500, and the exchange will close your position. And you get the difference because you have a buying price and you have a selling price. If your selling price is more than your buying price, you have a gain, and you take your gain, and you get your gain now. So we said therefore that, have a look at what we've done here. So therefore it tells us now the spot rate is now 160. Is everyone okay therefore that we are receiving dollars? So because we are a British company, we want them translated into pounds. The dollar has weakened, and so therefore we've lost money. We've lost 10 cents on every pound. So therefore spot now 160, so we've lost money. 1st of January the spot was 150. We would have received 62,500. Now we receive 160. Everyone okay where 160 comes from? So 160 is your spot rate, and so therefore your $93,750 exchanged at 160 will give you £58,594. Just one thing, is everyone okay as well that the pound is a bigger or a stronger currency than the dollar? Yeah. So therefore it is $1.60 will buy you £1. Therefore, if we just look at the spot market, in the spot market we have a loss of £3,906. Notice here that you've got to get your currencies right. I've measured it in pounds. And that's simply the difference between the 62,500 we would have received on the 1st of January and the 58,594 we actually received on the 30th of June. So in the spot market you have a loss of 3,906. That's step number one, this idea of closing out, or taking your dollars that you receive and simply exchanging them in the spot market. Now what we have to do is we have to close the future or square off the future. So it tells us on the 1st of January we bought at 150. Right, again, this is an exam question, so the spot rate and the future price are the same. That will not be true in real life, except for on the very, very last day of the future, when the two things will come together. So to close, we must do the opposite. So we sell. So we sell at 160. Right, that is your process of squaring off. And please notice, it doesn't matter which way around you do this. You can sell first and then buy back, or you can buy and then sell in the future. Some students have this kind of idea that, well, how can you sell something you don't own? Usually those students come from countries where that's a very common practice. As long as you both sell and buy in the same given period of time, it's absolutely fine. So you can sell in advance. Here though we bought. So we bought at 150 and we sell at 160. So our selling price is greater than our buying price, so we have a profit. And our gain is 10 cents. Please notice your exchange is in Chicago, so all of your prices are quoted in dollars. So we bought at $1.50, we sell at $1.60. So you have 10 cents for every pound. Your gain is 10 cents. Your denomination is 62,500 pounds. So your tweet. So therefore your gain is 6,250. Everyone okay? It's 6,250 US dollars. You are physically located in Chicago. Your gain is 10 cents for every pound. So your gain is $6,250. So your gain must be in dollars. 6,250 is your gain at the 30th of June. So if you exchange that gain at $1.60 for the pound, it gives you a gain in pounds of 3,906. Now see what's happened therefore is that your gain on your future has exactly matched your loss in the spot market. So therefore, you have actually received £62,500, being 58,594 in the spot market and 3,906 in the futures market. And that's what you've done. Please can you notice that this will not work like this in real life, because the chances of your spot rate and your futures price being the same is virtually zero. Okay, you need to go through that, learn it as a series of steps, and understand what we've done. Okay, this just sums up what came at the end therefore, and you need to be comfortable with this. That is a theoretical example of how your future works. As we said, in practice it won't work. It won't work for actually 3 reasons, even though there's only 2 reasons given you on here. The first reason is what we call basis risk, and it's this idea that the spot rate today will be different from the futures price. And the reason is simply because the futures price will include some expectation of future activity or future movement in currency prices. If you are buying or selling a June future on the 1st of January, the trader who's selling that thing to you has to think what's going to happen in the next 6 months. And remember that these things you can close these things out at any point. So he has to be aware of what the volatility of the currency is every day during those 6 months in principle. And so therefore your price will be different. So the price will be different. In principle, it will be the same when the bell closes, when these things get closed out on the very last day, because there is no opportunity for future price movements. So at that very, very close moment of time, at the very end of the month, well, at the very end of the month in which the future closes, they will converge. But it will literally be for 10-15 minutes in real life. The second thing is that we hedged here exactly 62,500. On the 1st of January, the sum of money in dollars that we were due to receive at the spot rate translated exactly into £62,500. If that happens, you won't get this if you get 62,500 or some multiple of 62,500. Again, the chances of that happening are very, very small. So you can see on the slide, I've given you a little note there. If we had needed to hedge £100,000, what would you have done? Well, you can either take, in our example we purchased, so you can either buy one future and leave unhedged the 37,500. 37,500 is the difference between 100,000 and 62.5. Yeah. So you can leave that 37,500 unhedged, or you can have 2 futures. If you have 2 futures, you're overhedged by 25,000. 25,000 is 2 times 62,500 minus the 100,000. So 2 times 62,500 is 125,000. Yeah. So you're hedging 125,000 pounds when you actually only need to hedge 100,000. Therefore, we get this idea that the underlying hedging instrument is based on a different principle from the loan itself, from the currency transaction itself. So we get a difference there. Again, if you're working for a large company which is doing this a lot, what can happen is that you can build bundles of these things, so you can match over hedges and under hedges to control the position, and that's what treasurers do in companies. But as a point of principle, you have an issue. Right, the third reason is fees, and we will come to look on fees on the next slide, and that's why I don't say fees and make that too long. So let's move on to the very last slide. Okay, so our final slide, and it says here future fees and other items. You need to be aware of what's happening with these things. Because the fee structure and the way that this works can be horribly complicated the first time that you do it. And when we say these things, we're talking about futures. Yeah. So the first thing that you have to do is you have to go along and you have to find some kind of a broker or an agent. That's nowhere near as complicated now as it used to be. In the good old days, it used to be horrible. But now it's quite easy. The internet means that there's lots of these people who sprung up. They have to be licensed or whatever by the exchange that you want to use. And so there's a process that they go through. Those guys have to be paid. Yeah, so you're going to have to pay them some kind of commission fees and so on. The first thing that you have to do, therefore, when you want to start trading is you have to put a certain sum of money on deposit It depends who you are. If you're a major international bank, it'll be virtually nothing. But for a normal Joe off the street, it'll be something approaching 3%. So 3% is some kind of deposit that many of these brokerages ask for you to put on deposit. That's 3% of the total. So in our example there, we were looking at 93,800 and whatever it was, $800. So you'd have to put 3% of that on deposit. And you've got to put it on deposit in dollars, yeah? Assuming that we're talking about Chicago Exchange, everything's in dollars. So if you're a UK company, you have to go out, take your pounds, buy dollars, and put those dollars on deposit. What will happen then is that the agent will act on your behalf. So they will go ahead and purchase the future for you. Second thing is that the trader himself will have some kind of level of concern that he's not going to be paid. The effect of that is that in our example we purchased a future, and with that future what's happening is that we're winning, we're gaining. If you're winning or gaining, you get all of your gains at the end. So in other words, we purchased a future. When we talk about the end, we closed the future out, we squared it off. So we squared it off by selling a future. And we had a gain of something which approximated to 3,000 something pounds. You get that money all at the end, so that comes at the end. Right, obviously with these things, we're hedging here the situation where the pound was strengthening against the dollar, but presumably in 50% of cases on average, we get these things wrong. So let's assume that we'd hedged against the pound strengthening, so we'd purchased futures, and then what actually happened is that the pound had weakened, so the dollar had got stronger and stronger. If that was the situation, we would have been winning in the spot market, but we would have been losing in the futures market. If you are losing in the futures market, what happens is that you have to pay the amount of your losses every day. So if you lose 10 cents on the first day and then another $1 on the second day, so you've got a total loss of $1.10, you have to keep topping up that loss. So what will happen therefore is that every day your agent will, if you're losing, will have to be topping up these accounts. Right, those things are called margin calls, and a margin call is actually the request for money. So a margin call isn't a payment, a margin call is actually a piece of paper. It was a piece of paper in my day. And what that piece of paper does is it tells you every day how much you have to pay across. Okay, so therefore it's to protect the trader so that you just don't go, screw this, I'm losing, let's just disappear. That therefore they have on deposit your money. So if you do a runner, your losses are covered anyway. Right, can you see that in terms of what you're doing with your initial deposit and with the payments of these margins, of these losses daily, it's kind of mucking up your hedging, because okay, you're trying to hedge movements in the pound dollar, but what we're doing is we're actually just putting dollars on deposit. And in some ways we might as well just on the 1st of January take the pounds, buy the dollars, put the dollars on deposit, and then they'll grow into the sum due. Right, so we've got this deposit, we've got these margin calls. The third one is fairly esoteric. It's called the maintenance margin. What will happen is that you've entered into this. We've said therefore that you have to put a certain sum of money on deposit. So let's assume that the bank has asked you, or your agent has asked you to put $3,000 on deposit. You've got $3,000 on deposit. Now what's happening is you're losing. So you're losing money. So every day that money is being reduced and reduced and reduced. So your $3,000 goes down, 2,900, 2,800, blah, blah, blah. They will set what's called a stop loss or a margin point when it falls to that point. So let's assume it's $1,500. Now you've lost $1,500. You've got $1,500 left. If that happens, what will happen is that the agent will come to you and you'll say you have to pay a maintenance margin. And your maintenance margin means you have to get your deposit back up to what it was at the start. So you're losing. You're halfway through this transaction, and then the agent comes to you and says, look, Mark, you got to pay another $1,500 to put on deposit. You have to bring your deposit back up. If you don't do that and you refuse to do that, what the guy will do is he'll close your position. He'll square off. So we bought a future. He'll sell a future, and he'll just close the position at that point. So initial deposit is the money you put on deposit. Unlike our example, now you're losing money. You hit some stop loss point. when you hit that point, the agent comes to you and says, you got to pay some extra money to increase your deposit. That increase in deposit is called a maintenance margin, and it's a sum of money you pay across. Okay, those are the major costs, plus of course the fees for the agent, and these guys don't work for nothing. Other little things that you need to know is price movement caps. If the movement of prices on a future is becoming very, very volatile, so they're going up and down very sharply, what will happen is that the exchange can step in and they can limit price movements. So let's assume that the value of your future suddenly increases by 5%. They can close that. So the institute will then the exchange at that point, what they will do is that they will say, okay, no more trading today in this future, and then when trading starts the next day, then you can pile in and purchase more if you think the price is going to increase again. It's to stop excess volatility in the market, so therefore people who are not experts in the market do not get stung. There are usually no price movement caps in the last month of trading of a future. So therefore people who are not experts but are deciding that they want to learn the system and try and gamble are usually advised not to hold futures which have less than a month to maturity, because there are extreme movements in the values of those futures during that last month. So price movement caps. This idea that the exchange will stop trading one day until the next day, and they set the things in advance so you can see what they are. Finally, which future to choose, because this is the one thing that students are usually have an issue with. Remember our golden rule. You choose the future which closes first after the risk ends. So the risk ends when you either pay or receive your money. So in our example, it's the 30th of June. So I recommended that we would use a September future, because if you use a September future, you close the risk. If you use a March future, then you're not covered from March up to June. If you use a December future, you'll find that your basis risk is greater. Generally, the longer the period until the closure of the future, the greater the basis risk. So that's where we get there. So please remember that in terms of your 3 questions. Okay, thank you very much for listening. That has been however many minutes. I can't actually tell from this clock. I hope that was useful. If you have any questions, please contact us. We do get a fair number of questions. We've got 100 or so students now coming on to us fairly regularly. The thing I really like about futures, it tends to be a guy thing. You know, guys want to do options and futures and stuff, and girls are much happier with Modigliani and Miller or whatever. But it's the kind of thing in the exam, particularly for ACCA, where you'll get good marks for calculations that are actually quite simple. Smash it down into these basic steps. Do I buy or sell? How many? Which month? If you can get that far, certainly as far as ACCA is going, you're going to get half of the marks. And then it's fairly easy closing out. The thing that used to be complicated in ACCA was that they never told you what the price was at the end. So therefore you had to make all these assumptions about basis risk declining over time and stuff. Just pick a number and go with it. As long as you get the structure of the thing right, so you know what number to use where in the calculations. It's fairly straightforward, and it's easy to get good marks. It's not like, you know, a general chat about Modigliani and Miller where it's actually hard to get good marks. With this, if you get it right, it's straightforward. And the questions are always the same. The questions, whichever institute you see, are always the same. Here's your transaction. How do you hedge it using a feature? Now what happens at the end? Okay, that's great. It's the middle of December 2013. So for those of you out there, have a great Christmas. And I hope you enjoyed everything here. Thanks a lot now. Bye-bye.